right. Hold on, guys. This is pretty loud. Give me 1 second. All right, that should be better. Sorry about that. I've got a new microphone, and it's a lot better than the old one, but it does pick up pretty much everything in the house. So, apologies in advance if the air kicks on or if my Sphinx cat starts making a racket. He can be really noisy. There's also the occasional fighter jet since I'm in Vegas. But this is Red Ben, and you can get a hold of me at, uh, at Red Ben Trader on Twitter. I should be able to turn off this desktop audio. Let me, if someone can tell me that you can still hear me, that would be helpful. Let me just check. Yep, looks like it's working. Okay, so we're going to take a look at the screen that I use when I execute trades, and it's different than what most people use. So, forewarning, it's complicated and overwhelming at first. There's a learning curve to figuring out how to use the algo. But if you want to learn more about it, give an email to my coach, Simon. His email is trade, the letter N, the word perform at gmail.com. You can ask him about the algo and about the futures trading room that I trade in every day with him. It's a great group. We're really only looking for a few traders who are serious about getting more consistent. So this isn't really a like advertisement or anything. We keep the room pretty small in general, but for those who do want to trade with a group that has edge, feel free to contact him. So this is what the algo looks like on my desktop. It is different colors and more complex than the one on Simon's desktop. So when you're new and you're looking at Simon's desktop, it looks a little bit more like this. It's a lot simpler to follow. And that's good all around. But over time, uh, I've developed some of my own signals, and Simon has shifted with the market to as necessary. When the price action changes, the regime changes, and a lot of times setups that worked really well in one regime kind of don't work as well. And so you need to always be on the lookout, back testing and forward testing your trade setups to be sure that they're still valid, that there's still edge there. And a lot of times, one setup will kind of fade out where we're finding that it's stopping like too often to rely on it as a primary trade entry. And so it'll get shelved, and Simon and the group will work together to figure out what tweaks need to be made to make it work in the current environment. Well, now that I've been using his algo for more than a year, uh, I've got a lot of trade setups on the shelf that worked in different environments, but maybe stopped working for a while. And since I have it on my desktop, and I'm just kind of the type of person that likes to explore things, and I've gotten a little bit better at programming with Sierra Chart. I've taken some of those new ideas or those old ideas and then mixed them together with some of my own ideas to try to tweak some of those old setups myself. So realize if you're in the room, you're going to see uh, things that are familiar but different colors. And then you're going to see things that are totally unfamiliar but may actually be on Simon's chart. It just looks different. For instance, these green color bars, the green and the orange, those are the volume shifts, which on Simon's algo looks like a little square. Well, I already had a square indicating a different condition. So I needed to use something else. So I used a color bar there. But, and then in addition, these dots, the blue and the yellow dots, those are my own idea. They're not the same as the dots that Simon recently added to the algo. The dots that Simon recently used or added to the algo, I'm not personally using yet. I need time to kind of dig into each setup, know where it works best, know what the expectancy is. I have a spreadsheet. I need a lot of practice before I get confident with a new setup. I don't want to put real money on the line for something that might be working for the group, but I don't personally have experience executing it yet. I just I just won't do it until I've had the time and the need to go back and see if it's working. See if I can do what they're doing. So I practice with them by opening up Simon's Algo, which, like I said, you can get on your desktop if you're a member in the room. But then when it's time to actually trade, I go back to the things that's been working for me. And a lot of times I will leave signals on here that maybe I don't really use currently because they used to be really useful, but now they're fading a bit. I will leave them there because what ends up happening is the condition is still important. You just have to tweak how you enter into the trade a little bit. And Simon, through coaching, has kind of helped me identify some of the ways that you can tweak those executions. So I leave them on the chart so I can keep an eye on them to see if one of those execution or those patterns that I've gotten used to watching for might be applying to some of those old signals. So even though I may not be watching like watching for it like a hawk waiting to pounce as soon as I see it, I want to know it's there so I can first of all analyze what's going on because it's alerting me to a condition either on the footprint or in on the DOM, the time and sales and the order book. So it it helps me to analyze the market to have them there, but realize you don't need them. If I wanted to, I could just pick one or two setups. I might be bored, but I could pick one or two setups, open up Simon's very simplified version of his algo, even simpler than what he's using now, and still find plenty of trades. For instance, like apex traps and triangles on pink bars and purple bars are really consistently good. So, for instance, here's a triangle and it's on a pink bar and that lifts. Here's a triangle, it's on a pink bar and that lifts. Here's a triangle and it's on a purple bar and that drops. And your target is the opposite side of this channel. When they show up above the channel up here, it's more dangerous. It'll only work when it's trending. So you need some momentum indicator, which this study angle kind of we used to use that. And once it kind of lifted, you knew you could be a little bit more aggressive with your breakout trades. But sometimes these will stop. Like, okay, so here, if you thought it was really bearish, there was a triangle on a purple bar. And it did kind of look bearish, but it failed. And so sometimes they're going to fail. So you need to know where you're wrong so you can have a hard stop there, and maybe you might even know you're wrong before the stop, but at least that way it protects your capital. But if you have, one or two stops, like here's another one, triangle up on the pink bar, stopped, and then it went. Um, but you've got plenty that get you at least 10 points. And it helps if you know the direction. Uh, all it takes then, like we'll call that like a 20-point win. All it takes is getting at least one 20-point win where you get all the way across the channel. And I'm usually back to even, if not green. So if I catch one of these where they happen to go 50, 100 points, chances are I'm doing pretty good that day. It doesn't have to be complicated. The idea is you just need to know what patterns you're looking for. And there's nothing wrong with having a simple strategy. Just know what the expectancy is so you can size appropriately. If there's a chance that you could take 7 stops in a row, even in conditions where you should actually keep trading based on your back test, like it's optimal to actually continue. There are setups where that's normal. Most of Simon's setups, as they're built, they rarely take 3 stops in a row. They're pretty high win rate. But if you simplify too much, if you don't have any filter for when you take a trade, you have to know what that number is. What's normal is 3 stops in a row without getting 10 points to the direction of your trade. Is that still normal? Or if that happens, should you stop and assume that the regime has changed, that you're doing something wrong, or whatever? And the algo helps make figuring that out, that number, pretty easy. It's just the only thing we have is past performance. And as we all know, we should anyway, past performance is not indicative of future results. So while the back testing might help optimize, it's not going to mean that we get those same results in the future. We could have a completely different market tomorrow than we had ever before. But in my opinion, it's the best I have, the back test and a forward test to see if I implement it. And I usually use Apex Trader Funding evaluations to forward test. So I will implement the new idea with an Apex evaluation, which costs me money, but it's not real money trading. If the idea works and I qualify the account, then I can get a real money account and continue to just do the same thing but get paid for it. But it's a good way to, for a relatively low business expense, it's a good way to forward test without having to be so anxious that I'm putting my real capital on the line, which isn't very smart if it's a new idea, but also gives me some sense of reward for doing it right, which is, in my experience, kind of important. Otherwise, I'm just not gonna trade very well. Like, I won't follow the rules if there's no benefit to winning and there's no detriment to losing. I'm just not going to do it right. And then I'm just kind of wasting my time, which is the worst thing you can really do. So realize that if I'm talking about a setup here, that it may be different than what Simon recommends to others and what he's personally doing. I'm not personally suggesting that anybody do what I'm doing, but I am willing to share what I'm doing if that's educational and useful or and at least entertaining to others. uh, it just realized that I've kind of made it my own. And a lot of these ideas, while they may have started from Simon, I've optimized in my own way so that it fits what uh, it fits with me better. Because there's some things like we're all a little bit different when it comes to what causes us to make mistakes. And you need to know before you go live with a system, you need to know how well you can execute that system, because if you're stressed about it losing, the risk is higher that you're gonna mess it up. You're just not gonna execute it correctly. And the risk then is that you'll take a max loss day or even go on tilt and blow up your account, which I have personally done, and it's no fun. So to keep that uh, possibility low. I'm not going to say to keep it from happening, because it can literally happen at any time to any person. So I'm not saying that I'm invincible from tilt, but it is my duty as a trader to do my best to avoid it. And one way to try to avoid it, or at least mitigate the effects of it, is to have some rules that fit my needs. So if I need a rule to keep me from doing something that has a high likelihood of leading to tilt, where then the possibility of me doing something stupid and blowing up increases, I should be following that rule. Even if it's of a rule that Simon doesn't need and doesn't use, I am responsible for my own trading, so I need to implement that rule. He might help me identify how and build that rule, but it doesn't mean he's going to do it. It just means I should. And that goes for everyone else too. So there's people in the room, for instance, that only take one or two trade setups, and they might set up 3 times a day max. And so they're doing a lot of hunting and not a lot of firing. They're just observing, waiting for some condition to occur. And then when that condition is there, they have practiced executing it, and they focus not on results, but how well did they execute their trade plan. So, and then there's others of us that have built a toolbox of setups, and we might be a lot more active, but we're also probably going to have a lower win rate. And while it's possible that you might not have very many red days if you have a really good win rate and a lot of setups, you're still going to sometimes be red. It's unreasonable, because all the setups have stops. It's unreasonable to expect never to have a red day or a red week or a red month. You can definitely help avoid the bigger blowups, but if you don't adjust and have a way, if you're not, if you haven't practiced adjusting to a change in regime, you can definitely have a long drawdown. But Simon has helped me a ton with limiting how long those drawdowns last. I'm not saying they don't happen, they do. Um, they just tend to, I know how to adjust as soon as I identify that I'm in a situation where I'm doing everything right, but it's not working. Whereas sometimes it would be working if I just did it right. And if that's the case, then the drawdown is being caused by my own errors. And the way to fix that is different. You don't change your setups, you don't make any optimizations to the program, you just change what you take. You take less trades, and you get in the rhythm of only doing what you're supposed to be doing. Because if you're, for instance, over trading, chances are you need to tighten the rules for what you're allowed to take. And one way to do this is to have conditions, or what I call filters. So, and thinking about this from a programmer standpoint, I want to trade, I want to make trading decisions similar to how a computerized auto trading algo would. I might want to have some human element, but I should have a decision tree that is very objective for when this trade setup can be taken, when it shouldn't be taken, how to get in, where to put my stop, when to get out, all of that. It needs to be based on something. What you base it on is up to you or the coach you're working with. And it's something that we spend hours on, just tweaking those little details, and then share those results with the room, so that other traders that are trading with us can kind of keep up with whatever changes we've done. But like I said, the challenge is that while that might be optimal for me, it may not be optimal for you. So just keep all that in mind as we go. So that's enough disclaiming, I think, hopefully, to keep everybody from thinking that I'm doing something inappropriate, since I'm not a licensed advisor, and I certainly am not suggesting anyone buy or sell anything. But I may be pushing the button if we get the opportunity, which has not occurred yet. I'm keeping an eye on it. The way to read this, or to at least begin to break down the components, you want to look in the window up here. These are all NQ. We're just going to limit to one product because it's complicated enough to look for all the setups and all that, and learning how to work with this. And so it would be overwhelming if I started pulling in other products, most likely, but realize you can, and I do. But usually I pick one or two to focus on for the day based on the higher time frame, and I pick some locations that I want to be active, and then I just wait for the market to get that location, and then see if I get a pattern that's tradable in my plan to occur at that level, let's say, or in relation to a test or a rejection of that level is really more accurate. But the tick chart, the tick number here, 15T means ticks. That's how much the market needs to move in the same direction to close an additional bar in that direction. So if you have this pink bar, which is a bullish bar, and we know that because there's a wick below it and the close is at the high, it's a flat top candle, shaved top candle. That's how the Renko bars look when they're bullish. If the market goes up 15 ticks from there before it returns to the open and goes down 15 ticks from the open of that previous bar, if instead it goes up 15 ticks more, it's going to print a new Renko brick here. And then same thing here. You can see that it tried to go lower. It couldn't even make it back to the open of this previous bar. And then it went 15 ticks higher. So this prints as a bullish bar. This one did get through the open of the previous bar, but it did not go 15 ticks lower than that open before it went 15 ticks higher. So it's a bullish bar. And we continue that until the market stops going in one direction. And based on what tick chart you're looking at, it's going to change, first of all, when the bar closes, since it's based on movement and extensions, or what we call waves, but not an Elliott wave. We're actually talking about Weiss waves, so volume waves. But those waves are going to be different based on what tick chart you have. And in the same way as markets are fractal in time frames, and I often call these time frames, which is not technically correct, it's a Renko chart, so they're not at all based on time, but it's similar to looking at a higher time frame. So here we have, you can't see it, but up in the blue, it says Renko 24T. So this one requires 24 ticks of movement to print a bar in the same direction. So you're not going to get as many bars on this chart when you look at the same period. So like if I look at this period, you get way more bars in that period of time on the 15 tick, and quite a few less bars on the 24 tick. So it's kind of like a time frame difference, and it's fractal like that too. So now here I don't have it showing. There we go. That should fix it. Nope, I don't have it copying from there. So I can figure out what that time is. It is, oh, never mind, not that one. This one. 11:58 Central. 11:54. So right there where that green line is, that one did copy. So here we only had one, and it was really just a portion of this because it started during that time. But let's say 1, 2, 3 bars up. And on the 15 tick, we have 1, 2, 3, 4, 5, 6, 7 up. 1, 2, 3 down. 1, 2, 3, 4, 5, 6, 7, 8 up. 2 down. 1, 2, 3 up. 1 down. Right? A lot more bars, a lot more zoomed in on this 15 tick, even though the information from the DOM and the footprint is the same. It's displaying it in different time frames, basically. The higher time frames, which for instance is the 67 and then the 24 is kind of like a medium time frame. But the higher the time frame, the more meaningful those signals in general, because for those conditions to occur, such as this blue dot or this pink bar or this X or any of the algo signals, you always need, first of all, to have a bar close. So for instance, on the current bar that's live on the 15 tick, we see a white triangle. That triangle is not valid until we close. It's warning me that if it closes bullish and the conditions stay the same, that it will have a triangle up. But if it closes bearish, or if those conditions change, that triangle could disappear by the time the bar closes. So once it closes, it's valid. But because it only requires 15 ticks of movement before that, like right there. So now that's valid. And that's technically a long if you think we're going higher, and there's really no reason to think we're not going to, because it's just kind of squeezing. Although it's very divergent. So I wouldn't do it, but it's aggressive. Let's put it that way. But what was I saying? Yeah, the white triangle here is on this chart is less meaningful than getting a white triangle on the 24 tick. And getting a white triangle on an even higher time frame, like a 67, that actually closes with the triangle on the bar, would be even more meaningful. It would carry more weight, and therefore if you have a setup, a pattern that we know works, for instance, on the 15 tick regularly, if you then find that exact same setup pattern on the 67 tick, you should probably expect the same sort of thing to happen. Only if you think about it, if the, for instance, if the setup is get a triangle on a pink bar and you're usually going to get 2 or 3 bars in that direction afterwards. That's basically how that scalp works. On the 15 tick, that opportunity begins anywhere around here at like 57.50, or else into this wick down here if you want to add on the pullback. And then we would expect it to go 1-2 bars. Let's just say 2 to simplify things. So we expect it to go to at least 65.25, which is where this bar will close. And I can see that over here. It's just kind of covered up by the current price. But you could do some math and say, okay, 2 bars going in the same direction after the triangle should be about 30 ticks. So we have the entry at 58, let's say, and then the close at 65. So it's not, let's just say 10 points. We'll say it prints 2 bars and then goes a little higher because I just want to make the math easier. So let's say the expectation is 10 points. And like I said, that's going to be, that's going to change based on conditions. But let's say that's what we found, that on the 15 tick, you usually get 10 points higher after a triangle up on a pink bar. So here we've gotten our 10 points now, I think, if it's gotten to 68, pretty close. I think it has. So again, we could say that's 2.5 or 3 bars. Well, the same thing over here should also be found. So if you have a triangle up, if like here, for instance, chances are you're going to get 2 bars to print in the same direction and then have the potential of maybe another or at least half of one. Well, this is 38.50, right? And then this second bar closes at 50.50. So in this case, it's actually less bars. It's only 2 bars, whereas here it was 3 or 4. But you've gone 10 points or more now, but yet you only have 2 bars. So now if we go to a much higher time frame, like a 67 tick, and we find a triangle up on a pink bar, what we should find is a similar pattern. Something, now this one failed. You can see this was at the top of the channel, and so it's very dangerous. You want to take it down here, preferably. Let's see if I can find one. Right here. So this is what you want it to look like. A pivot after a down move. You're at the bottom of the channel, or at least under the midpoint, which is the gray line on my charts. And then you get at least 1-2 bars, maybe more. On the 67 tick, those 2 bars, well, you get in at 13,300, let's say. This second bar, 1, 2, closes at 350. So you've gotten 50 points here, whereas on the 15 tick, you only had 10. But the problem is your stop, the place where you know you're wrong on this time frame, has to still be under the apex, which is this little flag looking thing. So that low is 62. So let's say we put our stop at, like, just to make the math easier, let's say 60, and we got in at 20. Like, that's a big stop, right? Like, for me, that's huge. So I can't just buy this because of the triangle on the 67 tick, but I do expect at this point right here, I do expect that shortly thereafter. Oh, why isn't this moving? Oh, I haven't gotten enough bars loaded. So I would expect once that triangle prints here, which happens right there, during this, whoops, this, let me just erase the lines. Oh, that's not going to work because that's printed somewhere else. Okay, beautiful. So right here, I know on the higher time frame, it's giving me triangle up. This one would not have printed yet in real life. But my expectation here is the market's probably going higher. Am I able to just enter there? No, because like I said, my stop would have to go under the apex. But if I got an opportunity to set up, get a setup with a better stop, like this, a star on this time frame, so all of a sudden once the star's there, or the triangle after the star even, I could say I'm willing to get in here at 63, and as long as I can put my stop below this star, which if it's really bullish will not get beat. So I'd put it at like 40, let's say. So that's like a 23 point stop, which is definitely better than the whatever that was, 45 or 50 points on the higher time frame. And then you get another one, so you could now move your stop here. And now you're profitable regardless, and it just keeps going, which is what we expected because we got triangle up on the higher time frame. You wouldn't want to buy a star way up above the channel. If you look, this channel is where most of the trading is expected to occur if it's neutral. So if it's balance, and especially when this channel is not going up or down at a 45-degree angle, but when it's flat, you would expect most of the trades to happen inside of here. You can see right now, well, at this time at 1300 at 1 o'clock on Wednesday, or earlier today, is that all? I didn't think, I thought I went back further than that, but maybe not. I guess not. So here, I'm surprised. You've been above the channel. You came back and bounced off the top of it and got a star. If it's not super bullish on a higher time frame like this, you don't want to take that. I can show you some examples where that stops in other conditions. If you find a star up there, let me find one. Here we go. So what does this look like on the higher time frame? Is this, oh, it is super bullish. Yeah, this is super bullish. See that? You've got triangle up on a higher time frame as well as a star. So we're going to have to, oh, let's go the other side. Let's see if we can find a short, because we know it's not bearish. So can we find a star down at the bottom of the channel? Well, this one's in the middle. That'll work. But at the bottom, here we go. See this? Star at the bottom of the channel trying to continue lower, yet the higher time frame at that same period doesn't look all that bearish. See that? We've gotten outside of the channel, and now we've come back in and we're attempting to bounce off the midpoint, which is basically similar to like a moving average. And this is the kind of behavior you expect for a trending market. It breaks out over resistance, comes back into a moving average or VWAP or whatever, and it might not bounce to the tick, but it's unable to develop any volume below that. If you look at the yellow line, that's where most of the volume was during that brick, when that time period when the brick was being formed. This is where most of the volume came in. Price got all the way down here, but most of the volume was up here. And then by the time they got down here, you had some volume here, and then they went lower with price, but most of the volume actually went higher on this bar, not lower, which is why it turned green. And if it's bullish, that signal in this location, it's usually pretty bullish. Sometimes you'll test below it one more time, and then if you go higher, it'll take out this high. So here, that is not bearish on the higher time frame, yet this lower time frame, whoops, gave us an aggressive seller at the bottom of the channel. And again, we expect, since it's bullish on the higher time frame, that we're probably going to come break this resistance eventually. A really easy way to do that would be to trap an aggressive seller, which happens right there. And you can see you get the X and the star up, you get the blue dot, and it lifts. And then you get the triangle on the pink bar. So that, when it's bullish, is going to lead to a big move, because on this time frame, you're bullish, so you expect to break this resistance, which, or at least test it, which is above 13,400, and then here you got a bullish entry at 13,363. So you have a pretty good opportunity there, and those are the kind of trades I want to take. The ones where I have both a lower time frame or a medium time frame that I'm able to manage risk with, it aligns with the higher time frame, particularly if just before entering it was not aligned. That's the opportunity is bigger if you can get some shorts to get stuffed. That will make these moves more extravagant. So, did I go? I went a week back. That's why. I was like, I thought I went a lot further than a day. Okay, so there has not been a lot to do, unfortunately, but we've gotten to talk about the algo a little bit. The problem with longing this is it's just squeezing. So while you could do it, like I said, this is where you do it. It is risky, and I just kind of don't feel like looking like a fool buying the top. But what's way more stupid, honestly, is trying to fight it. And I know it's tempting because you missed the move up and you want to ride the big reversal. But those huge full reversals are actually pretty rare. If people want to know what those look like, I can tell you and show you even what the algo shows when that happens. And then you can start hunting, if you have the algo, with hunting for those conditions so that you might not be right every time, but at least you have some parameters for what you're looking for. I will tell you one thing that happens is you get divergence on the volume zone oscillator. This is actually not part of Simon's algo. It's just on Sierra charts. But it gives you an idea of how aggressive buyers are versus sellers. And so here, buyers were not getting any momentum in volume as price continued to rise. And the result is higher highs on price, but lower highs on the indicator. Now, note that divergence on this time frame started here. And if you shorted that, you would not do very well. So you can't just look for divergence and expect it to reverse. But when you have divergence, there's the potential for a reversal. The trouble is the trend always has primacy. So because there are higher time frame traders trapped who are trying to fight the trend that you're now trying to fight, you're joining the weaker team, and most of the time that team is going to fail. It might eventually work, But by the time it does, you'll probably have been stopped out because the team that's in charge of the market at the moment is on a mission to hunt all the liquidity possible on higher time frames. And when I say possible, I mean they're going to keep pushing until someone stops them. You and I cannot stop them. That's a very, very important thing to remember. That is not our job. That's not what trading is. And if you feel that sense of wanting to control the market, you need to stop trading because that's a good chance. There's a good chance you're tilting. So it's a very common sign of our brains not like going through the decision making process properly and being charged with too much like emotion, basically, we'll just say. And you're not going to be able to make rational decisions because the part of your brain that does that is actually getting bypassed. And it's doing your brain is doing that as a survival technique because it's feeling that stress and it just wants the stress to go away. And so the fastest way to make the stress go away is to get you to stop trading. And if your brain can get you to stop trading by blowing you up, it'll do it. So you just have to assume that when you're in that state of mind where you're trying to stop the market from moving or make the market do something, that's not a rational thought. And therefore, you're probably not making decisions rationally. And instead, your brain or parts of your brain are trying to save you from stress. And unfortunately, the real result would be more stress. But the brain doesn't react like that. It doesn't think through what the results are of the situation. It's just escape or fight or right. It's fight or flight. So it sees an exit, it takes it. And if that exit is, hey, if I take one 6x trade of size wise compared to what I normally do, it's either going to work or it's not going to work. And all this stress of being stuck having to make a decision about whether or not I should long or short, those decisions will no longer occur. We won't have any decisions because we'll either have recovered or we've blown up. So from your brain's point of view, it's a survival technique. Just make the decision that gets you out of the stress. Like I said, it may not be a good situation, but you won't have that stressful decision to make anymore about should I be long or should I be short, because you'll either have recovered or you've blown up. So yeah, that's important. But once you've seen this divergence, the first thing that you must see, in my opinion, before taking a trade in the opposite direction is a triangle down. Here, we can try it if they come back up. The problem here is when you also have what's called hidden divergence. So the low is a higher low compared to the previous one, but on the indicator, it's making lower lows already. Chances are it's not going to extend very far. That short is going to get absorbed. Those sellers, they're going to find buyers for those sellers, and they won't have the energy to push through multiple apexes. So instead, the better choice in this situation is actually usually to wait for them to try to break down and then look for the continuation trade. It's frustrating because sometimes that fails and then you miss the top, but there's more failed reversals than there are succeeding reversals. There's actually only one succeeding reversal. One way to know whether or not you should continue to buy, like when I said that this one looked kind of aggressive and I didn't really want to take it, one way to tell whether or not it might be too late is on the volume zone oscillator indicator, as well as the percent R that I use. if you watch this purple line, which think about it like a midpoint, and then it's a weighted average midpoint, but then the white is basically a moving average. If that space in between the purple and the white is getting smaller, and then the yellow line, the percent R, rejected one of these levels, you're going to need divergence to save that bounce. No doubt. So, because right now, what it's saying is price is rejecting at a point where previously it was where everyone agreed value was fair. Because, like I said, think about it like a moving average. So you can see it as well if you just measure where most of the volume was on the way up. You can see most of the volume happened here, and then there was a high volume area up here that is acting as resistance, and that high volume area is basically right here on the indicator. We came up, we rejected, and now that level is resistance. Once we've attacked that white line and rejected, and especially if we then reach the Bollinger Bands, there's a good chance that it's not going to immediately bounce. It doesn't mean it's going to reverse the trend, but it's probably too late to chase. So here, the one reason I didn't want to take this trade was if you look at the white and the purple, the white was dropping and it was tightening here. And then on the smaller one, I noticed the white was actually crossing below the purple one, on the lower one, I mean, the volume zone oscillator. So volume was actually getting a bearish cross, even though price was going higher and we were divergent. So from my point of view, it was not quote unquote safe to long that. It doesn't mean it's never going to work. It doesn't mean it's time to short. You can't just short because of a moving average cross. That's not going to work. Not with futures anyway, not with a 10 or 20 point stop, but it can keep me from doing something stupid. Even though it worked in this situation, buying there didn't seem like a good idea. Just like buying here doesn't seem like a good idea unless we have risk reward to target that resistance. I'm no longer able to target the top because there's someone sitting in the way that basically got trapped. Now, if you look at this dotted line here, that is a time-based, what's it called? It's a developing volume point of control. So you can see that it shifts with price as the bars close and really as the volume develops higher. So the yellow line makes another higher high. You're going to see the dotted line shift up higher. And then as the yellow line drops and makes lower lows, what we should expect if it's bearish is for this developing VPOC to shift lower. If it doesn't, what you're going to get is a retrace. Those high volume areas act as magnets until they trap enough traders to push the market to the next area of high liquidity. So wherever there's liquidity, like sitting behind a swing low, for instance, like behind that, once you get there, the natural place for the market to want to go is back to this high volume area. Now, sometimes that means that you can buy that star because you expect the market to go higher. The problem with doing it here is our divergence that I pointed out earlier, that hidden divergence, that lower low on the indicator with the higher low on price, that's gone. Now we have a lower low on price and the indicators. That's not bullish. So while we will probably get back to this resistance, chances are we're not going to be able to develop volume with maybe anything but pink bars above this dotted line. And in fact, we might not even be able to get price over it. If we do get price over it, it's going to squeeze like crazy because everybody expects it to reject. And that's what's so tricky about trading, in my opinion, is you're trading against other traders that are all watching the same thing. And if they're good, they're probably expecting things to happen and preparing for, well, they know what everybody else expects to happen, and they are preparing to respond when that does or doesn't happen. And so this is one of those situations. I wouldn't be willing to buy the star because my risk reward is under 1-to-1. I'd be in here with a stop under this low, and my target would be right here. So did it hit the target? Yes. But how often does that have to be right to make that make sense to take over and over again? Pretty often. And like I said, sometimes it doesn't even reach it. So I know that this high is likely to be defended somewhere in here. They're going to try to show up and stop the market now that they have a glimpse of some potential, because along the way they have trapped a lot of sellers, and they're going to see dollar signs if they think that the bulls are done. Now they may get trapped. Those sellers, those new sellers, can get trapped, and you can get just another explosion of a wave higher. Right? That's always a possibility. If we look at volume, these accumulated volume waves, this wave here is smaller than the previous wave, yet it went to a new high. So if we do that again, where this wave does go through the high, but it's once again divergent, then we should be even more willing to take the next triangle down as a short, in my opinion. Once you've gotten that divergence, the triangle down has a better chance of starting a cascade. It doesn't always work, but if you got short here, the hard part is your stop really belongs at high of day, at least at first. You would need to take profits as you broke under this low, and then leave a trailer. That's the only way to trade that properly, in my opinion. You can't just sell and hold through all of this and then stop out completely. It's just not going to work often enough for that to make sense. But if you take, let's say, like 3 contracts, even if you're trading micros and you take them here, if you then take 2/3 off here, because that move is likely, and then you leave one, if it comes up and doesn't stop you out and then goes 100 points down, you're doing really good. Whereas if it comes back up and it stops you out, the trade was still profitable, not by much. It was only 1 micro, but it's something, and it pays for the opportunity to get the big roll down when it does happen. But realize that because that condition does not typically result in immediate drop, even though it does sometimes, usually the trend just continues, or at least it goes into a balance period where you're going to have better opportunities to take trades in the future if you just wait. Because of that, taking profit here when it approaches this low, and especially if it gets under the low and lifts, you'd want to take some off the table. Now, if you want to put it back on here, I'm not against that. In fact, I'll do it. So now I don't know if this is going to work, right? And it might totally fail, but the idea is valid. We had a valid short there that I didn't take. I would have taken profits here and still had the runner. It came up, it tapped that developing volume point of control, and it came back through the entry of the short, which was valid then. It has not stopped it out, and the conditions have not changed. Yet I've gotten now an aggressive seller showing up at that same location. So, and then if you look at the indicators, we don't have bullish conditions here unless we put in divergence. Then I do not want to be selling. But because there's no divergence at the moment, I'm able to sell that lower high. Now, the good news is whether or not you sold here or here, your stop, in my opinion, can really go here at like 64.50. There's no reason now to hold your stop all the way to high of day. If it does squeeze up here and then roll over, I can just enter again. I would rather take a 10-point stop twice than a 22-point stop or whatever it is every once in a while. That's just the way I see things. It might be more optimal for some people to leave their stop up here if those little scratches are going to cause you problems emotionally. Then you leave your stop up where you know you're wrong. But it can also go suck up liquidity up here and then roll over. So then you have to decide, how are you going to handle that? If you took a 24-point stop, are you going to be able to get back in? Should you be getting back in that scenario? Is it optimal if you did a back test over the last 100 days? Whatever you want to do to build confidence that you're doing the right thing. Like I said, even though it's obviously not a proof that it'll work, it for me, it helps me make the better decisions if I have a back test that supports the idea. Now, this might stop. And if it does, that's okay. It would be a small stop. But if it does work, it should be a rather successful trade. So I'm willing to take the chance, but like realize that there's, in my opinion, I don't see any reason to hold beyond like 63 at this point. And if they come tag me and roll over again, I can how would I say this? I wouldn't want to immediately get in this scenario, because what I would expect then is some kind of chop. But I would not be tilted. I would be able to continue to analyze the current conditions without too much trouble. Whereas if I took a 24-point stop here and then they rolled over, I'd have to make an immediate decision of whether or not I want to go short again. And I'm going to be a little bit frustrated, at least, by taking a larger stop in a situation where it was speculative. Because when it works great. But you have to be able to pay for all the times it doesn't work, since you are going against the trend. So it's not a 60% win rate. It's less than that. It is not going to work a lot. But as long as that stop is small, and when it does work, it pays me, it's okay. But you can see how that developing point of control, they're trying to use that as resistance. So that's a good sign for me for now. But if that becomes support, it's not bearish. This kind of has like a head and shoulders look. So it could just rip. And there's nothing you can do about that. Well, okay, there's one thing. If on the higher time frame you have divergence, you could skip the trade. That would be one way to say, I'm not fighting this because there's bullish divergence on the higher time frame. So here, lower low, higher low. So on this 24 tick, it's saying buyers are more likely to take advantage than sellers are. So I'll get out. Seeing that, I'll take a $120 loss. And give this a minute because that actually makes sense that I didn't look before, is that the 24 tick had already made a lower low. So the only way this is bearish is if we think this low is going to break. Otherwise, it's just bullish with hidden divergence. This one also made a lower low. It doesn't mean it's bullish, but the potential is there for the indicator to have, it has room to lift again and start the whole process over again. So on this time frame, it wasn't there, and that means it could drop below this, and maybe I was scared out of it for no reason. But if the higher time frame says, you know what, this still looks potentially bullish, you don't expect a big roll down. So why risk $300, $400 when my potential is probably no more than that? That's the problem. Had I seen that before I entered, I wouldn't have taken the trade, and so it kind of invalidated the trade. I didn't have to necessarily jump right out of it, but one way or another, after seeing it, it's like, oh, I don't want to be in this situation. And then, like I said, the higher the time frame, the more likely these not the more likely, the more significant the move is going to be when it does work. It doesn't necessarily mean that the win rate's higher. And that's a really important differentiation. So here, higher lows, right? So it's just bullish. It's not yet bearish. Is it extended? Hell yes, it is. It's very extended. Does that mean it's going to go to zero? No. It probably means that it's going to keep going. We just need these micro dips to participate, because we don't want to be the buyer who buys this and then has to hold through all sorts of agony only to see it blow up higher when we finally get it to work. Oh, where'd that go? 67, 16. Oops, I see. I made it. Okay, there we go. Sorry for all the lines. Okay. So, yeah, probably going higher at this point. You can see that we're putting in a pink bar, or, well, we haven't closed one yet, but we've got very low volume above this developing VPOC. And then the red in the background is saying that there's a potential that if it does close bearish, that there's more buyers than sellers currently in that bar on a different time frame. It's looking at a different chart and overlaying that divergence on this chart. So the green and the orange is delta divergence on a different chart. It's just telling me that on that chart, once that chart's bar closes, then there's divergence, delta divergence. But as you can see, it can disappear because that bar is not yet closed. So on another screen, I can see it. So here is what it's looking at. And so it was saying there was potentially bearish divergence here, but now the bar appears to be closing bearish. So it doesn't, there aren't as many buyers in this case. So it's no longer divergent, so it disappears. But you can see back here, this bar closed and it did have bullish divergence. There was more aggressive sellers on the bid than there were aggressive buyers on the ask. And the result is that where'd it go? I used the wrong one. How do I do that? Okay, so this area here, I guess I got to do it like that. Weird. that area here is likely to be defended. So when we come back into it, or even if we go under it slightly, if if we come back and see buyers defend it, it's probably bullish. So you can see they got into it, buyers defended, and now they're sitting on top of it. So sometimes you actually need to go under it and test underneath it, collect liquidity, and then if the buyers retake that zone, it can extend higher. When we see this where it pulls back and tries to bounce but it doesn't go anywhere, this is what happens during balance. So right now we should be expecting balance, and that makes sense because we've been going straight up for 2 hours. So on the higher time frames, it's just going to look like maybe one bear bar or a couple bear bars, but what we can watch for is bullish divergence. So here we had the bullish divergence and it resulted in a lift, right? Here we had bullish divergence, resulted in a lift. It would have stopped me out, right? It got above that stop, but then it came back and closed bearish again. Now, this does not look super bearish. Super bearish would be take out a low, lift, and then aggressively take out that low that you just put in. That would be a sign that we might get a V reversal. Here, we're not really set up for a big V reversal, and instead what this looks like is what I call ramp and camp. So they ramped up the price, and now because of the shorts stuck underneath, they're going to go and rest up here. And every time we test below a low, they're just going to show up and buy it. And when I say they, I mean the people who are short, because they want to be out of those shorts since they see price going higher. So like it's a sign, it's a bullish indication, and it usually occurs when you have a lot of hedging. For instance, before a Fed meeting, or in this case with the potential U.S. default, if they don't raise the debt limit, there's just a lot of people short. So all it takes is a little bit of bullish action, and they all have to cover because they don't want to lose. They were over leveraged. So the result of that is price goes higher. It struggles to trade back down because whenever it tries, all those traders who were losing money get a chance to get out of those trades at a cheaper price, and so they do it. And in addition, everybody who missed the move on the way up sees this as an opportunity to join in, particularly if you get a breakout of any highs. You can then potentially trap buyers, and then you could get the reversal that everybody was initially expecting. So it's confusing, but it's a matter of sequencing. It's where are you compared to where all of the over leveraged traders are positioned. It's just about positioning and where the pressure is being put and which side, if it's neutral pressure or if one side is under pressure to see something happen. And when nothing happens or the opposite happens, they, even though nothing's changed in the macro view of things, they want to deleverage so they don't risk taking bigger losses. So the result is ramp and camp. Now, keep in mind that because of that, because the higher time frame has trapped sellers, it doesn't mean we can't go lower, but we want to be very careful on the higher time frame. Whoops, that's ES. And that's CL. On the higher time frame, Oh, I see what it is. On the higher time frame here, we want to be very aware of any aggressive sellers that show up and what happens to those aggressive sellers. Because if somebody takes a stand here, again, we're not going to do it as retail traders, but on a higher time frame, if they can either trap a buyer that's aggressive, something like a triangle up or a star up, and then we can get under it with a triangle down or a star down or an X down, any of the aggressive signals on my screen from the algo, there's an opportunity there that the shorts might get a little bit more emboldened and we might see some follow through. Usually what you're going to see is the lack of aggression and just sucking up liquidity below here and then coming up and getting a breakout. That's usually what's going to happen. But we can watch and see if we get that divergence that we would expect when that occurs on one of these time frames. So, for instance, a higher low on an indicator when we got a lower low on price followed by an aggressive buyer and preferably a triangle up, a white triangle, is what we'd want to see to expect that swing back up. But remember that we did have a divergent volume wave. So it's still possible that these guys are trapped up here, right? The problem for sellers is there's also sellers trapped right here. So for sellers to make any progress, they're going to have to reclaim this low with something more than just a purple bar. A purple bar is not going to be enough most of the time. So here they got a purple bar to reclaim that aggressive location. Let's see if they can get a real bear bar, and especially if they can destroy this divergence. Then we might get a roll down. Otherwise, it's buy triangle up. See here how we've got a higher low, and then we probably have it on the higher time frame. Oops. We're into some earlier single prints from a different day. So this did not quite make a lower low. So no divergence there. It may not be ready yet. But there is divergence here. So if we can get a triangle up, we can try to come back up to the high. It's a scalp, but it's going in the direction of the trend, so it often works. You could technically get in if you have a star here at 46.50, one tick above when this bar closes, because then you'll know that it's not going to repaint. So let's see what we get here. We get a ring. Okay, we'll do it. For demonstration purposes, we'll be a little aggressive. This ring, when followed by a triangle up, is very powerful, but without the triangle up, you have to be a little bit careful. But it's a one bar stop. So if it immediately turns back around, it's just done. And since I saved myself a couple $100 getting out of this one early, I was willing to get into this one a little early. So let's see. Our stop does go, my stop goes underneath here. It really should not. It can, but if it does get underneath like 37, I want to wait for the trap back in, which is often going to happen. You're going to have a drop and then a lift, and that's okay. But most of the time, when you get ring followed by triangle up, especially when the developing volume point of control, that little dotted line, got all the way to the low like that, you should expect buyers to defend that. If they don't, it's probably not long. So see how it came back into this bar and they defended it? That's what I expect. Whether or not it gets here, it's up to the market. But what I saw was once you see this, chances are dips are going to get bought as long as it's bullish. I have evidence that it's bullish on multiple time frames. Yes, it's quite extended, but on this time frame, I've had a lower low on price and a higher low on the indicator, the volume zone oscillator, which is where I prefer to find my divergence. So I'm willing to try to get 10 points here, and then I'll hold the runner, and if they want to go to high a day or higher, cool. Now, notice this pink bar, or this triangle, was on a pink bar, and that pink bar is located low in the channel, or even below is better, but anywhere down here underneath the gray line, it's okay if the high closes above it, but the little yellow line where all the volume is, we really want that to be below the gray line if we're trying to get some sort of a dip buy opportunity. That gives us the better risk reward, because a lot of times the channel is going to act as resistance. And so if your pink bar gets you long right here, you don't have a lot of room to resistance. And even if you held it to here, the chances that you get this high before you sweep up liquidity down this below this low is decreased, because the triangle showed up on a bar with a VPOC above the midpoint, that gray line. Now I realize it's not the midpoint of this shaded channel. The shaded channel is a fib channel. It's the same concept as a Keltner channel, but it's using Fibonacci retracements and like as an expectation for how far a natural extension would be. I don't know, this could still stop. Realize it could be bearish, but when it's bullish, it should work. But the Fibonacci channel is something I use in a similar way as Simon's Keltner channel, the blue. But I find the midpoint of this Keltner channel is actually the more important line, because all you really need to do is figure out how far away you are from that midpoint. And it doesn't really matter if it touches the edge of the Keltner channel. You just don't want to be going in the wrong direction. Unless you're trending, then you can expect a breakout of some kind. But if you're not trending, or if you're fighting the trend, you don't want to get involved on the wrong side of the channel. It doesn't matter if you touch the line or not. It's just, are you closer to one side or the other? And so the midpoint of that channel, which is the gray line here, is all I really need. But the shaded areas act in the same way as the blue Keltner channels. They're just a little bit more responsive, because it's based on a Fibonacci retracement rather than a standard deviation. So it's just a different calculation that's going to result in more opportunities. It also means that the win rate will be lower. So if I assume that I can take any longs at the bottom of the channel, sometimes if I was looking at the Trading Perform Keltner channel on the Trading Perform algo, it may not be touching that. And based on Simon's rules, you can skip those trades and you'll probably do better. And he's right. But I find that the fib channels are, along with using the midpoint of the Keltner channels, is a pretty good balance of not doing really stupid stuff based on location, like relative to the current rotations, but also gives me extra opportunities for trending conditions. Whereas the Keltner channels become pretty useless when you get above them like this. You can sometimes get a dip into them that bounces, but if it doesn't touch it, you don't really know if you should accept it as valid or not. So like here on the 24 tick, it got above, but it didn't come back and test it. So if your rule was that it needs to test it before I get long, then for the last 3 hours or 2 hours, you haven't really been doing anything, which is fine. I mean, I took a stop and I might take a second one, so it's not wrong. He's right. But I also, while it might mean more stops, I can also have more opportunities to recover from those stops. So for me, it works a little better. This might actually stop. That's a little bit of speed. Let's see. Do they get it under it? Oh, it missed me by a tick. I have it just a little bit under it. All right, it got me. So that was a full stop? Yeah, it was a full stop. That's too bad. Now, thankfully, I got long here and not here. So it wasn't as big. It was only like a 10-point stop. But it was a full stop, which is the risk we take. And again, how to avoid that would be we had a divergent wave to the high. We had potential trap buyers here. And that's what acted as resistance. These guys. Right? That was the resistance. And I knew to get to the high, I needed to break through them. But there was a chance that it worked because I had divergence. And then I had moved. I saw them shift volume lower and push price higher. So when it's bullish, that's going to work. What that means is it's not bullish. And the frustrating part, the place that I can get frustrated with is now what do I do? Because the trade that was reliable for joining the trend has failed. And the best opportunity for fighting the trend, which was here, has already passed. Because remember, I said this one that I took, I didn't really like and exited early because of the divergence on the 24 tick. That one stopped, but then they immediately rolled it over again with the triangle down. So that was a valid short. It would have been totally acceptable to take that. Diamond on the inside, followed by triangle down with the trend is good. It's bad if you're against the trend. So I would have had to read this as bearish. Now, the white line did get under that purple midpoint. That was more bearish than bullish. Here too. So on this time frame, there was reason to think it was bearish. The problem that I had with selling it is that I thought that the trap shorts on the higher time frame would probably act as support and I wouldn't get much of an extension. And I was kind of right about that. You can see that it would have gone down and then I would have probably exited because at this point I don't want to turn my trade into a loss. And so it would have been a win, but it would have been hard to hold through this whole rollover. That extra attempt made the sell a lot harder to execute. And that's just a matter of having confidence with what you're doing. But in this case, I did not have high confidence that we were going to take out another low. And so sometimes you're wrong. And as long as you have a way to mitigate risk, like a max loss on a day or whatever, then you can be wrong. That's acceptable. You just have to be wrong in the right way. You want to be wrong with a trade plan and a setup that you know usually works. Other than that, I mean, that's the best we can do other than manage risk. So now Do we have divergence? No. So we're not looking for a long purple bar followed by divergent dot. That's a really strong signal. It if it's bullish, it will lift. But we don't think it's bullish, in my opinion, because we've broken down off of this move here that really should have worked. So, in my opinion, I would be surprised to see this break, but if it does, it's going to be explosive. So, if we can get above 46.25, we could have like party time rip to the highs because it would be very unexpected. Other than that, we just have to watch for the follow through short. But I'm not going to take this reversal without divergence. And I'm especially not going to do it after I just took a stop going in that same direction when I actually got over the dotted line here, which is usually what acts as resistance like here. We got over it and then it shifted higher. So we shifted volume up, got price higher, but then price gave up. So what's probably going to happen? Rip up, roll over. But like I said, if they rip through this, any dip can basically be bought because
Would you
that's
like to
just...
talk with an Alexa Prize social bot?
Alexa, go home. Talk about buying things and she's listening. I definitely did not say the A word, Miss A. So like I said, this is a pattern that Simon trades. He takes this and he may be long. I'm not watching the room right now since it's not really fair to share what they're doing with you. Unless you're in the room, then you can be in there. But had I not taken this one, this is a better setup. But when I see this fail, usually this is resistance. So I wasn't willing to take the risk here. But let's see. I suppose the risk reward back to that level isn't horrible because you'd get in here, stop here. You'd have more than 1-to-1. I suppose that might be the right choice. Higher time frame has still not gotten up back there. Oh, do you now have divergence? Yeah. Okay. Well, that's interesting. So we didn't have it here. Is that what that means? At 40? Oh, I'm looking at the wrong chart. That's... Okay. That's CL. Sorry. My goodness. Okay, so on this one, do we have divergence? Nope. Lower low on price and the indicators. No divergence. No reason to think we're going to bounce. Did I look at the wrong chart earlier to get out of that trade? That would be funny. I might have had CL get me out of an NQ trade, which is not the way you're supposed to do it. Oh, that was interesting. See that? The DOM just, like, everyone pulled their orders and we had an aggressive seller come in. You could try to sell it. This is very speculative, but getting... I probably should wait for a retrace here. Getting a speed bar with a star down in a bearish environment is usually pretty bearish. But I could have waited for a pullback rather than getting short all the way down there. If they pull back, I'll consider adding. But that bar, especially the location of it, with the volume coming right up to the dotted line, which is like a time-based developing point of control, that, and then when you're making lower highs and there's no divergence to the upside, we're probably going to take out that low. Do we have to? No. So now on the 67 tick, we've closed a bearish bar. So if they get the triangle down, especially if they had divergence, I don't think they did. If they did, I would expect a return to at least the midpoint here, which would be like 84.50. Let's say 84, I guess. Nope, 73. We'll say 74 would be the target if they can print this triangle bar. But if they don't print that triangle bar, what we're going to get is probably that. And you won't know if the triangle bars print until 78.25. So you kind of have to make a judgment call on a smaller time frame, since I'm not going to take a stop at the high of day with an entry at 78. That's not acceptable for me. And again, that might have been news. It kind of looked like news. Let me check. Just scrolling through Twitter, see if I see anything newsworthy. I don't. Nothing recent, anyway. Okay. Like I said, I'm not in the room right now, so there may be something that I don't see, but whatever. So see how they're retracing this? That should be expected. On a big drop like that, they're going to go check to make sure natural sellers are there. And it makes more sense to sell the retrace, which I thought about immediately after hitting the button. But left it anyway. So, not optimal execution, but sound theory anyway. But that's what you want to short, is the pullback there. Or up here. You don't have to short so low when you're not breaking out. That's the basic rule. Don't short, don't market in if it's not a breakout. So I just got a little bit anxious there. And it may cost me, right? Those decisions in futures can cost you a lot of money. And I will leave the trade to demonstrate that. And then I can review it and improve my execution. So again, I'm watching this dotted volume point of control line to see if they're shifting volume lower, and currently they are. You can see it's shifted lower, and price is having a hard time establishing volume above that, meaning they put volume up here and close it bullish on a bar that's not pink, because the pink bar basically just means a lack of sellers. It's not necessarily anybody like really aggressively buying. It might be, but the majority of the move occurred due to order pulling. So it's not enough evidence to take at face value. Now that it's white, if it closes bullish, I'm probably just done with the trade. And would be frustrating because had I waited for the pullback, I could have actually gotten short up there. But if they attempt to push down and instead price comes up here and closes up here with the volume up there, the yellow line established above the dotted line, there's really no reason to hold the short, because the only reason to be short here is if I think buyers are panicking. And that's not a sign of panic when they can close a bullish bar. So here, now if you look here, we're setting up potential divergence, but we'd have to make a lower low first. So what that means is I probably want to take some profits as we drop into this low, because if they bounce, it's potentially going to be a big bounce. If they don't bounce, you want to have at least one runner left over, because that divergence can absolutely go away if this bar doesn't close bullish. You'll watch and see that red line point down if this gets bearish. But right now, if it went close up and then went lower, it's going to be a divergent low most likely. And in that case, I don't want to be short. So instead, I'd have to get out of the short, wait for that to happen, and then see if they bounce it. Alternatively, if I didn't short it down here, I'd wait for that to happen and then follow an aggressive trader's short if they didn't have the divergence. But it would save me a stop by waiting. You could also miss a breakdown, but that hasn't, selling breakdowns today hasn't worked so far. So, and this wasn't even a breakdown. It was just an aggressive seller on the DOM. And then a move quickly away from a level that had a lot of participation. That's what the diamond inside says. Okay, so there's our drop. So I want to be taking some profits in here. I don't want to get left out in the cold if they turn this in. See how it looks divergent? So if they get down here, I'm going to quickly cover half the position. I might have to do it anyway. They're not doing it. I'd like them to slide down there. And then I'll hold the other half in case they cascade. But right now they're defending. And there's nothing more frustrating than missing your target by like 3 points. So I am willing to adjust a tad. There we go. Okay, hit my initial target. Whew, 10 points. All right. So profitable trade. And now I've got a runner, which is great. But not perfect execution, because I easily could have shorted that instead and gotten that scale a lot earlier and been a lot more comfortable. So note the purple bars down here means that buyers are just kind of gave up. And so if they bounce it here, it's probably going to lift. If they take back this level and get the yellow volume line above that, it's done. It would be a little suspicious if they did it with a pink bar, but yeah, that runner might stop. So sellers need to defend this here. But this should make sense. We have divergence. We had purple bars breaking down. And, of course, it's going to be a pink bar. Okay, so if that bar closes, I'm out. If it closes bullish. It's not pink, and the VPOC is currently above the close of that earlier aggressive bar, the one with the dot that caused the move up. So if they can get volume above 13,635, I don't want to be short. Note they shifted volume lower, so they might play games here. Suggests to me that this is a very thin market. We're getting a lot of unidirectional movements with low liquidity. Not my preferred price action. There may be someone speaking. I didn't see anyone on the calendar, but there may be. Because it's kind of trading like there is. All right. I am stopped on the runner. Still a profitable trade, but small. The potential is there, but the divergence and the purple bars underneath the apex suggested that the pink triangle up would get a lift. I could have technically taken that trade, but yeah, I didn't love it. Let's say that. Oops. So let's see what they do here. Right up to the voodoo range level, 13.6, 42.75. Oops. Oh boy. I don't know if you guys can hear that or not, but I don't want... How do I mute it? There we go. Okay. All right. So I'm glad I got out of the short, but you'd have to be pretty aggressive to see these fail and keep taking the long. But to be fair, they've worked all day, so no great reason not to do it. It's just hard. But it's a good example of how in these low liquidity environments, one side just can take advantage and kind of push the other side around. And I'm not going to chase it, by the way. Although you probably could. Let's see. So Simon's expecting higher. I wasn't. I just decided to peek because I had gotten a DM, so I thought I'd check and see what they're doing. And not surprisingly, thinking long. And that makes sense. I just wasn't confident enough. It was there. I had divergence. I had triangle up on pink bar. Could have taken it. But that's okay. At least I'm not short anymore. So on the 24 tick, oops, no divergence at all. White underneath purple just doesn't look that bullish on the 24 tick. The reason it's so bullish is because on the higher time frame, such as the 67, you've got a breakout, a pullback into the channel top, and then a lift. And that is bullish. You don't even need divergence for that to work. And you can see the white is expanding away from the purple on both. And those moves are just really hard to fight. And it's not recommended to do it. You can also look in between those. Like here's the 40 tick. And here you had star down at the top. That makes sense. No divergence though. And then here, hidden divergence to the bull side. So lower low, higher low. Bullish close. Bullish volume shift and a bounce off of the channel top. Now, these are pink bars. So on this time frame, there's not a lot of it's just illiquidity. Price is rising, but there hasn't really been, other than just some follow through, which is what the triangle is telling me. It could go higher, but there's no new aggressive trader identified on the DOM, and they're fighting this aggressive trader up here who showed up there, more or less. In the wick, let's say. So we come back up, see if he's serious about selling, and if he's not, we take his stop. And that's the way the market works. And then when he is serious, he defends, and then we take this stop. But you can, this is something I missed. So the Bollinger Bands squeezed on the 40 tick and then broke down. See that? So that is usually a sign of, what's it called? Range expansion. So usually what you get there is this or this. But one or the other, it's not going to consolidate for much longer once you get this. Then the question is, is there a chance that you could push it any higher? And that's going to depend on a higher time frame. So when you see the squeeze, you'd expect the breakdown out of the squeeze to work, usually. But if the higher time frame is super bullish, it won't. And that is kind of frustrating, but this is just the way it works. It's, okay, I shouldn't say it won't work, but it'll be harder to get this extension lower because of trap shorts on the higher time frame. And so this liquidity up here is at risk. There's a good chance that eventually we break that high. But I don't mind selling this breakdown with the squeeze. If you're going to pick a spot, that seems like a decent one. Now, if we do turn here and break this low, and there's no divergence here, I wonder how often that turns into a reversal. Because it kind of makes sense that it would. Like this high should be relatively easy to beat. So failing to do so would be telling. Definitely feeling a little FOMO about skipping this pink triangle up, but it was speculative. Up 1% on ES. Let me just double check ES. I have not been watching that. Oh, interesting. They're back into last week's range. Just barely. So on ES, let me pull it up. ES, where is it? Okay, so on ES, we said the yellow triangle's up. If it's bullish, is going to work pretty often. Here we missed it by 1. That's too bad. But the purple triangle down did work for like the first time in a long time. Oh, well, this one worked too. So they're just, everything's working. Oh, you had divergence here too. Look at the volume. Very weak. So where is all the volume on ES? It's at 41. It's right here. 41.72. Have we gotten any aggressive sellers below that? This guy's so close. Right on it. This star. His volume is literally where all the volume is. We got under it. Now we just have to get over it. So if we can get to 73.75, it could probably break out. I don't know if there's divergence here or not. But I would think that is an important spot for sellers to hold here. Triangle down into the bottom. Lift. But again, if they can't even close a bar above that center of volume, it's going to take out the low. Interesting. Not a lot to do. So here we had this big, oops, this buyer and this buyer both got reclaimed. And that typically means you're going higher when you reclaim those big buyers. And then the seller, who I followed in, has been trapped. And this big seller has been stopped out. And so now, to be bearish, we need to recover that close, which is basically 13.642.75. So if we can't get under 13.642.75, I probably shouldn't be shorting. The other way to look at this is to see it as balance. To take, the volume profile and just measure the whole thing from when stuff starts to cool off. And you can see most of the volume is actually up here, right where we are right now. So if the sellers are going to defend, this is where they'll do it, which we talked about earlier when we were up there before. And that's why that initial entry that I took short kind of made sense. We're right back into that spot again. So had I taken this one, when that little one stopped out and it immediately fell back down again, that's an acceptable entry short. And if I take that, the stop for that sits up here. So getting up there with price has the potential to blow off the top. Otherwise, we'll just balance here. And as much as I'd like to be part of this move, the fact that I didn't take the entry that came up, there's really nothing to do